Hey, what's going on, everybody? It's your boy Q.G here. Hey, I just want to take a minute to thank everybody for tuning in and watching. This is the very first episode of Frequently Asked Questions, or FAQ for short. Now, a lot of people out there know me and know that I have my own clothing line, What's Your IQ? And I've had it for a few years now, and I feel like I've been pretty successful at running it over the past few years. Throughout the time of having the clothing line, there have been a lot of people who've also come to me and asked me because they wanted to do something similar themselves and everything like that. So, me being me, not hesitating to provide them with information that I know personally, or if I didn't know the answer, I always knew someone else who did. So it was in that time frame where I just, after getting asked over and over and over again certain questions and stuff, I just decided to start a new platform, again, what I like to call FAQ, or frequently asked questions. So I'm expanding this beyond just clothing line and things like that. The big thing is for me to just talk to a lot of friends and other people that I know personally who are in some other sort of business where they are pretty much successful and have a wealth of knowledge that a lot of people may want to know but don't really know who to ask or whatever. So this platform right now is created to, get those questions from other people and bring them to you. Or maybe somebody else who wants to start their business or do something in life that they don't know exactly where to go, and everything like that. So what I want to do is just bring this to the people that I know personally and everything, and hopefully they'll share and have others watch this video or these videos and everything, because I have a lot going on right now. So again, this is the very first one. And I'm asking a lot of people to be patient with me and, help me better myself and, the way that I can do this show or whatever, so that I can continue to provide information for people, because it's all about networking. It's all about staying positive and helping others grow. And so that's what I want to do. So I'm interviewing other people, again, who have a pretty good wealth of knowledge and everything like that they can provide to you in order for you to grow and progress and everything. So with that being said, my very first guest on the show is a person that I've known pretty much all my life. Our families grew up together, and we grew up together and everything like that. And now she is a mortgage processor down in the state of Florida. She's going to have a lot of information to kick out. So I hope that everybody enjoys it. This video right here is going to be about buying homes and buying rental property and a lot of other things that go along with that. And then the background process and everything like that. And that part right there is key, because she's going to explain her job, in a pretty good amount of detail. And on top of that, if you guys stick around, she's going to have some valuable information for a lot of people out there, people who are, unemployed right now and are looking for work. She works remotely from home and everything like that. So she's got some information to give out to you guys. So I need you guys to stick around at the end, and we're going to get that information to you. But again, the information is about people who are, or for people who are, unemployed right now and are able to work remotely, have, all of that good stuff, the internet and everything like that, a nice computer, and stuff like that, as well as people who are in a career field that they, just aren't happy with right now and everything. So stick around. She's got a lot of information for you. And all that good stuff, and we're going to get right into it. So again, frequently asked questions. I need everybody to just be patient with me, tune in, listen. This is just the first of many videos and everything that I've been able to do. And so yeah, man, I'm just hoping that this is a success. I'm hoping that everybody gains something out of this, and that people can network, not just in your own little communities, but around the world and everything, to make the world smaller, the more that and more people that outside of your circle and everything like that to help you grow your business or whatever it is that you're trying to do. uh, you can kind of come together a lot more and everything like that. And this is what we really need to do, is start to build each other up and everything like that. So that's what I'm trying to do. I'm trying to make sure that everybody's successful and everything like that. So without further ado, we're about to dive right into this very first video, frequently asked questions. All of the links and YouTube channels and all of that will be in the videos at the end. So stick around, and here we go. Not in my lifetime, wasn't in my right mind. Somebody would have told that you was so close top. Not in my lifetime, wasn't in my right mind. Somebody would have told that you was so close top. Not in my lifetime, wasn't in my right mind. Somebody would have told that you was so close top. Not in my lifetime, wasn't in my right mind. Somebody would have told that you was so close top. Not in my lifetime, wasn't in my right mind. Hey everybody, what's going on? It's your boy Q.G, and welcome to the very first episode of Frequently Asked Questions. I'm here with my good friend Shanekarhett. She is a mortgage loan processor down in the state of Florida, and she is going to be here with me today to answer some questions and give out some pretty damn good info for all of those out there who are currently unemployed and or possibly looking for a new career path. If you're in a spot right now where you just don't like it or you're not loving it and you're pretty, computer savvy and attention to detail oriented, you might want to stick around to the end of this video. We got some good info for you. So let's go ahead and get started. So Nika, without further ado, I'm going to give you the floor and let you go ahead and introduce yourself, and then we'll get started. Well, before we do that, happy holidays. How was your Thanksgiving?
My Thanksgiving was great. Okay. We had a pescatarian Thanksgiving.
Pescatarian Thanksgiving.
I'm not sure if I said that right, but it was seafood.
Okay.
So there was we had salmon rolls and lobster tails and seafood dressing, crab dips. So no turkey, no ham, no traditional.
Nothing traditional.
But it was great.
That's what's up.
How about you? Celebrating overseas, what's that like?
Oh man, shit. It was all right. I did what I usually do, which is go to a restaurant. Hung out with a few players from the football team. I play flag football out here. So hung out with them or whatever and got drunk. My typical Thanksgiving being overseas.
You ate some ham?
I did. I had some ham. I had some dressing, turkey. What was the pie we had? Pumpkin pie. Pumpkin pie.
Oh, we had key lime.
And a lot of shots. Some Jack up in there, some Henny. It's pretty good Thanksgiving. My type of Thanksgiving. Minus the family and everything. Would have rather been with them. But
and did you stop and embrace what you were thankful for, other than in between these shots?
Washington beat Dallas. I mean, but that was after the Thanksgiving for me. But that was probably the biggest takeaway I took away from everything. So yeah.
Oh, they don't got a quarterback though, don't they?
I don't really care about that.
Oh, don't matter.
That's
okay.
Next man up. It's not my concern. Anyway, now that we got all of that out of the way, the floor is yours. Introduce yourself. Tell us a little bit about the mortgage processing that you do, who you work for, and all that good stuff. And then we'll get into some questions.
Yes. Hi, I am, my name is Shanekarhett, and I am a senior mortgage processor at Caliber Home Loans. I have been processing for a little over 12 years now. I started off at a bank. I worked at Wachovia, Bank of America, and then I worked for an actual mortgage company, a brokerage firm, and then now I'm at Caliber. I have a degree in finance, so my background is in finance. I've done some underwriting, I've done processing training, I've been subject matter experts, so I've been around for a bit when it comes to mortgages.
Okay.
The role that I have now is primarily with refinances because the interest rates are so low right now. So everyone that bought in when the rates were a little higher in the high threes or fours are now refinancing and getting lower threes and high 2% interest rates. So that's where the bulk of the business is right now for me.
Now, when you're talking about threes and fours, that is the percentage of the interest rates on the homes, correct?
Correct. 3 or 4% interest rates.
Okay.
If you bought your home within the last, I don't know, before the pandemic, last year before last, 9 times out of 10, your rate was probably 3 or 4%. And now the interest rates have gone down to 2% or low threes. So a lot of homeowners are refinancing to take advantage of that lower rate.
That's what's up. So just to be clear, like your part in the home buying process, because this all ties into buying a home or whatever. So your part in the home buying process is to be the person who go ahead.
I facilitate. So when you go to buy a home, you need a loan, obviously, because most homes are hundreds of thousands of dollars, and most people don't have that just sitting in their bank account. So you go to a bank or a brokerage firm and you apply for a loan. That loan process is where my job is, what comes into play for me. So I am your direct contact to the underwriter who's responsible for approving the loan, who's in direct contact with the lending guidelines, who says, the investors are Fannie Mae, Freddie Mac, FHA, HUD, VA. These are all the investors that invest in mortgage loans. So they have a set of guidelines that are in place that have to be followed to say whether or not you're approved for their loans. So the underwriter is the one who makes sure that that approval is in place. And my job as a processor is to gather all the documentation that we need from you, from the appraiser who's going to tell us how much your home is worth, from the title company who's going to tell us if there's any liens on the property, from the flood agency who's going to tell us if you're in a flood zone, to gather all these pieces of information and provide it to the underwriter to see if we can get your loan approved or not. That's my job. So it's a pretty extensive process. A lot of people take home buying as like it's quick, or it's like applying for a credit card or auto loan where it's just a couple clicks and that's it. But it's a huge responsibility. Like it's a 30-year debt for the most part. Like the average mortgage is for 30 years. So there's a lot of paperwork involved. There's a lot of basically you trying to prove to these lenders that you're responsible enough to carry a mortgage for 30 years, that they're going to get their money back from you, that you're not going to bail on the house, that they're not going to have to foreclose on your property. So that's where I come into play, is building the best case possible so we can submit it to underwriting for the approval.
That's what's up. So let's talk about, like, I heard you go through all of that, but we want to make sure. So like when somebody comes to buy a home, like let's talk about getting their ducks in a row, as I like to call it, or whatever. So like what are some things that would get you denied, or at least slow down your process if you don't have it like properly in place for going to buy a home?
Right. So when you're looking to purchase a home, there's a couple of key things that are important. One being your current income. Because if you're asking someone to borrow money, you need to have a job to pay them back or some source of income to pay them back. So the most important thing, or one of the most important things, is going to be your income. Investors pretty much across the board look for a 2-year history. Sometimes with your FHA products, you can get away with maybe a year and some schooling or some training that you've had. But for the most part, they want to see that you've been in the same line of business for 2 years. That you're not hopping from job to job to job, because it's all about risk. If you put yourself in the position of the lender, if I come to you and I say, hey, can I borrow $500,000 for a house? And you say, okay, well, let me see your work ethic over the last 2 years. And I hop from McDonald's to being a gambler to being a dog walker to being in the nursing field. Like, I'm all over the place. So my income is all over the place, and that's risky. So they want to see that you're consistently working in the same line of business for at least 2 years for your income. They want to see that the amount of debt that you currently have is in a direct relation with your income, like you're not overextended. So if you make $1,000 a month, but you have $2,000 a month in bills, you're upside down on your income. Right. So they're looking to see that you have no more than, ideally they want like 45, we'll say 50% for easy math, 50% of your income to go towards your debt. So if you make $1,000 a month, they want to see that you have no more than $500 worth of debt. Okay. And that's with your new house payment. Okay. So you have to look at what's outlined on your credit report. So anything that's reporting to your credit report, your credit cards, your auto loans, your student loans, any secured lines of credits that you have, all of those take an account and they're reporting on your credit report. So you would basically take up your monthly payment for all of those and divide that by how much income you make every single month. And that's your debt to income ratio. That's a percentage. And that the lower that number is, the better. The higher that number is, you need to work on either increasing your income stream or reducing your debt. But one out of the two, they need to be at a 50% ratio. So after you make sure you have your income in line, you've been stable for 2 years, you got your debts down to at least 50% or less. The last part of it is your assets or your funds in the bank. And that's basically to make sure that you have your down payment and closing costs covered, because again, you're going to buy a house. If it's $500,000, you have to put some of your money into it. The bank's not loaning you 100% of your purchase price of what you're buying the house for. They're not going to give you all of it. They want to see that you have your money invested into it, because you're least likely to walk away from it if you put money into it. So if somebody just gives you a free house, you didn't work for it, you didn't put any money into it, you're least likely to just walk away from it. But if you had to put $5,000 down or $10,000 down, investors feel like you're more likely to stay in the home, which is least likely for them to default if you have money in the bank. So with cash, when we talk about assets, there are funds that the investors will not take for the transaction. It's not acceptable. They won't accept it. For example, cash isn't accepted. Lottery earnings aren't accepted. If you win the lottery and then go try to put that money into a transaction, it's not acceptable as cash. So there's a list of funds that are not acceptable. What you can always bank on is your income. Your income's always going to be accepted, provided it's legitimate income. If you work, you have a job, pay stub, W-2s, that's going to be accepted. If you're self-employed and you file tax returns, you pay your taxes, that's the type of income that's going to be accepted. If you're retired and get pension, or you're disabled and get Social Security, those are all incomes that are going to be accepted. When you get unconventional and you start saying, oh, well, I do hair on the side, but you're not reporting that through the IRS, you're not filing taxes, that's not income we can prove. We have to be able to prove it. So any type of assets, any type of money that you have going into your bank account that's coming from a legit income source is going to be accepted. You can also get gift money. So let's say you don't have any money at all, but your parents have a couple $1,000s that they can give you, and they have it sitting in a bank account. They can gift you that money. And they're basically saying, I'm gifting my daughter $5,000, $10,000 to purchase her home. She doesn't have to pay me back. So you can get gift money as well. It has to be, can't be cash. It can't be from an illegal source. That's the main gist of your assets. So once you have your income, your credit, your funds in your account, those are the bare minimum. That gets you started. That gets you through the door. As far as getting an approval, they are going to look at anything that's negative. So like I said, with each area, they're going to look at negative with income, negative with credit, and negative with assets. So with your income, like I said, if you've been hopping from job to job, that's negatively reviewed. It doesn't mean that you're going to get declined, but it might mean we need some further explanation. Do you have a history? Are you going to keep hopping from job to job? With your credit, if you have anything on there that's derogatory, let's say you filed a bankruptcy or foreclosure, you had repossessions, There are seasoning requirements. So if you just had a repossession last year, 9 times out of 10, you're not going to get approved this year for a home. They want to see, because there's not enough time that's lapsed to say that that's not going to happen again. Yeah. So they want to see, have you gotten another car? Are you able to make your car payments on time? Or if you filed bankruptcy, are you able to manage debt again? Or if you had a previous foreclosure, they have to have passed. Usually it's like 3 to 5 or 7 years where since your last negative occurrence has happened before they want to try you again as far as lending credit to you. So it's not the end of the world if you have derogatory credit, but we definitely want to see that you've been able to bounce back from that derogatory credit, that you're more responsible now, that you are able to pay your bills on time. Or if you've had an extenuating circumstance, so let's say you lost your job or you got sick or your child got sick, your parents got sick and you couldn't work. Those are extenuating circumstances. And with the right documentation, if you're able to prove, yes, I had doctor bills, or yes, I was laid off from my job, or I was mentally ill, I couldn't work. If you're able to document that, those are extenuating circumstances, and lenders will look at that and still proceed with an approval. And then with assets, they're looking for any negative things with your assets would be if you've overdrawn your bank account. They take a look at that because you're providing 2 months bank statements. So if you're bouncing checks every other week, or if you got overdraft fees, they're looking at that because that's you managing your money. So they're going to ask for explanations regarding that. And no, it's not a good look if every other month you got, $35 or $70 worth of overdraft fees. They look for any large deposits because they're lending out money. They're regulated by agencies to make sure that they're not being a part of any money laundering. So you can't try to move your drug smuggling money through your asset account and then try to use that account to purchase a home, because they have rules that they have to follow too. So that's a huge reason why we can't use cash, is because there's no way to trace it. There's no way to say that that's not coming from money laundering. So I always say, if you're going to put cash into an account, put it in an account and let it sit for about 3 to 4 months. And once that cash has sat in the account for 3 to 4 months, then you go and you can apply for a home, because at that point it's seasoned funds. It's not, you just have this lump sum of cash that came out of nowhere in the middle of your transaction.
So let me ask you something about that cash right there. I think we talked about this before, but so when we're talking about that type of money, that type of cash that you get in a lump sum or whatever, does the account that you put that money in have to show that there's money going into it after it's there, just to prove that point? Or is it like, you know what I mean?
No,
like
so you can, when you get ready to purchase a home, it's best to set up an account specifically for that transaction. So if you want to purchase a home, let's say within the next 6 months, you're thinking about buying a home, get you an account going now, start an account. If you want to use cash, throw all the cash you want in that account. And once you get to a point where, okay, this is the money that I'm going to use, or this is enough and I'm not adding any more additional cash, that's when you would start your 2-month cycle of no transactions at all. That's the cleanest bank statement. If you don't have anything coming in or out, if your beginning balance and ending balance and all you're doing is increasing with the interest that the bank is paying you, that's a clean bank statement. So you don't have to have money constantly going into the account. If the money's been there for 2 months, we're not asking where it came from.
Okay.
Because in the investors' minds, the funds are seasoned at that point. There's no, how the investor looks at it is, if you have a large sum of money, they're looking for, did you go get debt? Did you get into debt to get this money? Did you rob a bank to get this money? They're looking for something that says, where did this money come from, that could be illegal, that could put them in a compromising situation. Right. So within a 2-month time, we're able to see if you did, let's say you took out a loan for your down payment. Within a 2-month time, we'll be able to see some type of payments coming off of your bank statement, or a new account showing on your credit report. Like, there's ways where we can monitor to see if you've opened up new debt. So we're constantly monitoring that. And then so the cleaner the bank statement is, you have no transactions going in there, and it could be separate from your payroll account. Or your paycheck account. So let's say you have a checking account where you pay your bills out of, you got your income going into, you might throw random cash that you get into that account. You don't have to use that account for closing. You can open up a clean account a clean savings account, even if you want, or checking account, and just put your money in there. We don't have to have the least transactions, the better. So if you have an opening account with $5,000 in it, and then for the 2 months straight, that's all we see is the 5,000. That's perfect. That's clean. There's no transactions. We know that money is safe, secure, sound. Nobody's coming to look for it. You don't have to pay nobody back. So that's kind of how to get around the cash. It's not that it can't be used, but it needs to be seasoned. And seasoned is in your account for at least 60 days.
All right. So something else we talked about offline as well, or whatever, that I want to bring to the people, and that's first-time home buyers. So you had some good information for me or whatever the last time or whatever, and I want you to share with the people about first-time home buyer. I think we're talking about like grants and all of the other cool stuff. So
Yes. So if you are a first-time home buyer, and the definition by the investors of first-time home buyer is if you haven't purchased a loan within 3 years. So if you bought a home 10 years ago and it's gone and you haven't made any purchases within 3 years, you haven't owned a home within 3 years, you're considered a first-time home buyer. And under first-time home buyer, there are tons of grants that are available to help you come up with your money for your down payment. Because remember, our investors, Fannie Mae is an investor. They have a 3% down payment program and a 5% down payment program. FHA, you have to put 3.5% down, and this is of your purchase price. So if you are buying $100,000 house on an FHA at 3.5%, you have to put $3,500 down. If you're doing a Fannie Mae loan, that'd be $3,000 down. Or if you're doing the 5%, that's $5,000 down. If you have VA, so for military, VA will allow 100% financing. So that's a program where you can borrow 100% of your loan amount, is if you qualify for VA financing. And USDA will also allow, that's if you're like in a rural area. It falls under FHA, but you can also do 100% financing with VA or with USDA. But if you're going the traditional ones, FHA, Fannie Mae, Freddie Mac, you're going to need at least 3% down. And that money can come, there's grants, there's bonds. Every state has them. Here in Florida, we have a bond program where it used to be $15,000 they would give. But the bond money comes from the government and regulation, so that those funds do end up running out. But now they have a program, you get $7,500 towards your closing costs for your down payment. And I've processed hundreds of those loans where borrowers come to the table with no money because they have $7,500 from their grant. And the terms of the grant are your debt to income ratio. So they're looking at that, how much income you have versus the debt that you have going out. There's a qualifying criteria for that. You can't have owned a home within the last 3 years. It has to be your primary residence. So you can't use grant money for investment properties. You have to, for real, be first-time home buyer buying a primary residence that you're going to live in. You have to live in the home with it for 5 years for the money to be fully forgiven. So if you stay in the home for at least 5 years, the $7,500 is fully forgiven. If you try to sell the home prior to that time frame, there is a stipulation in there that you sign where you'll be responsible to pay that grant money back, because the intention of it is for it to be your primary home. So,
all right, let me ask you this before you keep going. So, selling is different than renting. Can you rent it at that time?
So no, there's
so selling and renting is the same.
There's
falls under the same
formalities
category.
that you sign. There's documentation that signs that you say, unless, and most of them don't allow you to. Oh no, they do have some that will allow a duplex. If it's a 2-unit, you can rent out 1 unit and live in the other and use that for grant money. But if your sole purpose is for it to be an investment property, you can't use grant money for that.
Right. Okay.
It has to be you living in a part of the home or in one of the units.
Okay.
But every state has them. You can check with, you can look up grant money for first-time home buyers in your state, and they will give you a list of grants that they have, the lenders that accept them. Not all lenders will take grant money, because when you process grant loans, you're processing what your lender requires, and then the grant program has their requirements on top of it. So you usually have a double set of overlays or guidelines that you have to follow, and some lenders don't want to deal with that. But there are plenty of lenders out there that they handle grant money. the lender that I just left from, they did second chance loans. So if you got denied by your typical bank, you could go to them and you could have a 500 credit score, 550 credit score, and get approved for a loan. So there's definitely second chance lending. There's grant money. There's assistance for buying a home if you're really interested about getting it done.
Okay, cool. Something you just talked about was the lenders. So let me ask you real quick about the lenders. Who chooses the lender? Is it the person buying the home, or is it the processors?
Right, you as the home buyer.
Okay, so you can
You
say I
as
want
the
to
home
use
buyer
Fan
gets
Me.
to
I
choose your
want to
lender.
use Fan Me or.
Right. So typically, when you go to purchase a home, you can start like on Zillow. Let's say you're on Zillow and you're looking up, you're filtering homes that are for sale, and you see one that you want to buy. There's a realtor that would show you the home. And that realtor could have a preferred lender that they usually use, someone that they work with who they kind of know. The process will go smoothly. You'll get approved kind of quickly. If not, if they don't have a preferred lender, somebody that they would recommend, and you're free to choose whatever lender you want. There's banks, there's mortgage companies, there's brokers. I mean, the funds are limitless. So you can definitely choose whoever you want. Borrowers shop around for rates because different lenders are going to have different rates that they're able to offer. So you can definitely, it's kind of like buying a car. You want to, you just don't want to go to the first dealership that has that amount. You can shop around for your lender. You can shop around if you don't like your realtor. You could look for different realtor because your realtor is supposed to have your best interest at heart, making sure you get everything you want in that house. So definitely you can shop for your lender. You can shop for your realtor. The only thing you don't get to pick is your processor. So once you pick the lender, that lender already has processors working for them. So you will be working with, whatever processor that they have assigned for you.
That's what's up. Moving on now, let's talk about rental properties for a minute. So we talked about first-time home buyers and everything like that. For people out there who like to invest, who have their home already, but have a little bit of cash, and now they want to make something on the side or whatever, and be a person who buys their second home or their third home, or maybe let's say their second home, just for this one, because if you paid for your second, or you're going to your third home, chances are you've been through the process before. So let's talk to the people out there who are already homeowners in some capacity and want to buy some rental property now.
Okay, so rental properties, when you go to purchase a rental property, the requirements, it's still the same important key factors. So they're still looking for income. They still want to make sure you've been on a job for 2 years. They still want to see that if you've had any derogatory credit, that some time has passed since that incident, or it was extenuating circumstance. They still don't want to see large deposits going into your bank account. So it's still those base criteria. It's just a little more strict because investors are known to not be tied to properties. They flip them and they walk away. So what the lender has no control over is who you're flipping it to. So their property, they can't control that. So they make it a little more strict for you to obtain the loan, to make sure that, again, the more you have in, the more invested they feel like you'll be, the least likely you are to walk away or to negatively invest in the property, I guess, or to make the property go down. So with rental property, they want to see that your down payment is bigger. So you're not going to get your cute 3 and 5% down payments. You're going to have at least a 20% down payment for investment properties. So $100,000 investment property, $20,000, that's your down payment now. There aren't grant monies for investment property. So those are your coins, or you can get a gift. If you've got mommy and daddy who want to help you get an investment property, you can definitely get a gift to purchase an investment property. So the asset requirement is higher. Also for funds and investment property, now you're juggling multiple properties 9 times out of 10. So you have a primary and now you're going to go get an investment property. Now the lender wants to make sure if you lose your income, you can afford both. Let's say you got an investment property and you're going to hold it on your books for a year because it's going to take a year to get it upgraded and renovated before you can sell it out. You're responsible for that mortgage payment until you sell it. So they want to see, do you have money in the event that you lose your job or COVID happens? How are you going to pay your bills? So they want to see you have reserves, and reserves are equivalent to 1 month mortgage payment. That's a reserve. So for investment properties, you can have a 6-month reserve requirement where if your mortgage payment is $1,000 a month, they want to see you have $6,000 reserved in an account separate to, if anything happens to your main stream of income, at least for the next 6 months, you can still make your mortgage payment. Okay. So in addition to a larger down payment, you also have that reserve requirement, and they can tack that reserve requirement onto each property that you own. So 6 months on your investment, you got a primary, we want to see you got 6 months on that too. You got a second home, we want to see you have 6 months on that too. So assets are definitely fluent, and you need to have them on investment properties. The good thing about assets is you can use your 401ks, you can use your pension, of course, checking and savings account, CDs, bonds. It can be investments account. It doesn't have to be liquid money right now. You can definitely use your investment accounts for reserves. So that's the big difference between purchasing an investment and purchasing a primary residence. The credit score requirements are a little more strict on investment properties. 9 times out of 10, you're going to at least probably need somewhere between a 660, 680 to be in the ballpark of getting financing for investment properties, because again, you're this a little big boy status now. Now you're not the first time home buyer that's green and don't know what you're doing anymore. Like, you're able to manage properties. You're going to have multiple properties. So they want to see that you're able to pay your credit, pay your debts on time. So your credit, assets, the property that you actually purchase. And we didn't really talk about this for first-time home buyers, but when you go to look for your home, the bank's not going to loan you money on a property that's not worth what you're purchasing it for. So you go in this house, you go in this neighborhood, and let's say you see this house and, oh my gosh, it's so amazing, and it's $500,000. And I gotta have it, I need it, it's $500,000. So they go in and they have an appraisal done on the property, and the appraisal says this is what the value is compared to other homes in the area. And that's a big misconception too, is people feel like their appraisal is based off of their house. It's not. They're comparing your house to similar homes in your area. Mm-hmm. What do people pay for those houses in the area? Not your house, but that's right. What your value is driven off of, homes in the area. So if you see a $500,000 house you want, and the homes in the area are only selling for $250,000, 9 times out of 10, the house is only going to be worth $250,000, and the bank, we're not giving you $500,000 on a house that's only worth $250,000. So, being cognizant of the home that you want and making sure that the value is there, because when you get ready to sell a house, you could put your house on the market today and say you want to sell it for $1 million. If somebody thinks it's worth $1 million, they're going to pay $1 million for it. Right. But on the flip side of that, when you're getting lending and there's, you need financing, we need to make sure that our collateral, the property, is actually worth what we're going to lend on it. So investment properties, when it comes to purchasing those, a lot of those are fixer-uppers. A lot of those properties are foreclosed properties that people weren't able to take the mortgage payment on. They weren't able to keep the mortgage payment up on it, so they walked away from it for whatever reason. And now, like anything that you don't want anymore, you don't treat it with the best of care. So there could be holes in the walls, there could be roof, the lawn could be overgrown, the cabinets could need to be redone. It could really need work. So when the appraiser goes out to appraise the home, if it's viewed as an investment property, there's leniency for those type of things. They understand those type of things, that you're going to be rehabbing, that there might be a hole in the roof, opposed to when you're buying a primary, no, you can't have a hole in your roof. That's not, absolutely not. That's not a thing. You can't have any health or safety issues with your primary residence at all. So if there's outlets that are exposed, or wiring that's exposed, or broken windows, anything like that on a primary has to be fixed. Absolutely has to be fixed. You can't have any health or safety issues when it comes to moving into your primary home. But for investment properties, that's looked at as a little bit different, again, because you're going to be rehabbing the property. You're going to be making the repairs on the home and getting the property up to where you can eventually rent it or sell it to make a profit out of it. So that's the gist of it with collateral. Outside of that, I don't think the rates are a little bit higher on investment properties than they are primary residences because, again, it's a higher risk. So they're going to give you a higher rate that's tied to that. So you're not going to get your low twos and low threes with investment properties. They're probably going to be maybe around mid threes or 4% rates for investments. And I'm trying to think, is there anything else different? Your homeowner's insurance requirements that you have to have. They're looking to see, do you have renter's insurance? And that's an added cost to your homeowner's insurance premium when you have renter's insurance. So that's a little bit that's a requirement that we're looking for, is to make sure that in the event that something happens, the renter in the house is actually protected. Because if they're not, that means they're coming after you, which means they're potentially coming after us. So the insurance is also a little bit higher on investment properties than it is primary residences. And I think that's it. I don't think there's much difference. Everything is pretty much the same. It's just a little bit stricter. It's just a little bit more microscoped, I guess I should say.
Okay, so moving on, I guess. Earlier I heard you mention, like, we were talking strictly about 30-year. You said it's like a 30-year investment and stuff like that. So from my understanding, however, like there are different years and amounts of time for mortgage loans and everything like that. So there's 15 and probably a few others that I don't know
right
about.
So the standard is 30-year, and that's just because of the amount of money that's being borrowed. Right. When you get a car loan is usually a 3-year, a 5-year. I think now they might go to 6 or 7, but for the most part, it's a shorter amount of time because you're borrowing a shorter, a smaller lump sum of money. When it comes to a house, there's hundreds of thousands of dollars involved, so the term is longer. So 30 years is the standard. You can do a 15-year. That's going to double your payment. So if your payment was, $1,500 on a 30-year, it's now going to be $3,000 if you're doing a 15-year note. You can do a 10-year if you want to be that aggressive. The term itself, really what's changing is your rate and the amount of payment, your monthly payment. That's the difference in the term and the rate. They also have products where you don't have to be fixed into a certain rate for the entire 30 years. You can do an adjustable rate mortgage, which that means your rate will fluctuate 5, 7, 9-year periods where, if the rates are lower, you can take advantage of the lower rates. And if the rates go up inadvertently, you also are subject to those higher rates. But those are more for people who they don't have just your flat $100,000 salary that they get every year. And maybe they are self-employed, maybe they're investors and their income kind of fluctuates and goes up and down, and they want to be able to pay their mortgage payment like that as well. So you can do an adjustable rate mortgage and have your rate adjust. And then you can get into either and say, I want to refinance and flip to the other. So you can be an adjustable rate and say, no, this isn't working for me. I want to refinance and go to a fixed rate where I know my payment is going to be the same no matter what the rates do, I need the same payment. Or you can be in this fixed rate and be like, no, I want to take advantage when rates go down. I want to be able to, take advantage of that for 3, 5 years, whatever. And you can refinance. So any rate program structure that you're in can always be refinanced. If your situation changes, your financial situation changes, and you feel like there's a better setup for you, definitely you can refinance and take advantage of that.
Okay, cool.
So that's a huge reason why people refinance, is to kind of get reduced rates, to change how their payments are set up. You can take cash out when you refinance on your home. If you have equity in your home, you can pull money out to take trips or do rehabs.
Well, just hold on for a second, because that was like one of my next questions or whatever. So I wanted to kind of segue into that myself or whatever. When it comes to refinancing, is there a time limit Like as far as the time that, okay, I signed, you know, on fucking December 1st to buy my home. Like, is there a time limit, you know, from that point forward that I have to have the home and I'm making my payments and everything? I say
6 months.
6 months. Okay.
Yep, you have to be in your home 6 months before you can be eligible for a refinance. Um, and the contrary to that is you can refinance every 6 months if you want. There are closing costs that are involved, so you are obviously, um, it costs to refinance, and then you start your term over again when you refinance. So they always suggest if you're going to refinance, it's good to do it early within the first 2 to 3 years of you getting your home, because when you get down to you've paid, you know, 15, 20 years on a mortgage, and then you talk about refinancing to start all the way back over at another 30-year, it just seems like bad math. But if you get it up front where you're only 1, 2 years into it, you refinance and you don't see that. That's not as detrimental as it would be if you waited to get that far in. Um, you can do a rate term refinance where they're just reducing your rate. Um, Again, as long as you've been in the home 6 months, that's not equity driven. So your home doesn't have to have value in it to do a rate term refinance. You can be upside down and do a rate term refinance where your home can be worth more than what you owe on it. I mean, you could owe more than your home is worth. Or you can do a cash out refinance. And a cash out refinance, you actually have to have equity in your home. So you need to owe you need to have like at least 20% cushion built in. So if your home is worth $100,000, your mortgage balance can't be more than $80,000, so to speak. So in that case, you have equity of $20,000 in your home, and you can borrow against that equity. You can say, I want to take that equity out, and I want to go take a trip, or I want to send my kid to college, or I want to get married, I want to have a baby, whatever. You can take that money out and use it like a credit card and swipe. Now you're borrowing against your home, but your home is an asset. You're borrowing against yourself, so to speak, instead as opposed to, you know, a third party. This is your asset. This is your home, something that you want to eventually pay off and pass down from generation to generation. Like, you can use your home as an asset. So refinance to get a lower rate, refinance to take cash out. You can refinance to gift the home to someone else. Like if I want to give you my home, then we would do a refinance. Yeah, sure, just here, you can have it. We would refinance it. So my name would come off of the deed and your name would go on. So they do for ownership change, you could refinance. I think that's it. Rate term, cash out, ownership change. Yep.
Okay, cool. All this has like been really some really good information thus far. Um, Fixing and flipping. I think that falls along the lines of rental property, maybe, I'm not sure, or investment property, but you guys do
Yep.
those as well?
So in my current channel where I'm at right now, we only process refinances, so we don't do the fix or flips. Those are going to be in your purchase channel, and yes, I've done those. I've processed those before, and they go under just the same rules as investment properties. Fix or flip is you don't plan on keeping that property, so you want to fix. You want to get in there, you want to fix it up, and you want to flip it and make a profit on it. So if you bought the house for 50,000, you put $50,000 worth of work in it, you turn around and sell it for 200 grand. You flipped it. So you made $100,000 profit on your investment. Those are the fix or flips. They're really quick. Most lenders don't support fix or flips just because, well, I'm not going to say most lenders. You can get investment properties through lenders for fix and flips. Most investors, me, if I'm the one that's fixing and flipping the house, I typically don't want to deal with lenders because of the amount of time that it takes to get through the process. It can take 2-3 months to process a loan application. So if I'm trying to fix and flip houses, 9 times out of 10, if I'm an investor, I could be getting a house at an auction, or it could be a deadline today, tomorrow. I don't have time to wait 2 to 3 months for a loan process if I'm trying to fix or flip. So there's hard money loans that are available where there's other investors into real estate or just financial investors, period, who say, I'll loan you fix or flip money. So you can come to me, you can get a loan for, let's say, a year, because that's how long it'll take you to fix and flip your property. I'll give you the money up front to buy the house. I'll give you usually like 150, 160% of the appraised value for you to work in your repairs that you're going to need. And then I need my money back in a year. So those hard money loans, and you can look up in your area, hard money loans, hard money investors. Those are the ones that are more prominent for the fixer flippers if you want cash in with your investment properties, just because they're quicker. They understand, you can get the money quicker. They understand the investments. They're not digging all into everything like how lenders are. They understand the risk involved already, and they're prepared to handle it. So those transactions move a lot swifter than, going through a lender for a fix or flip.
Cool. Something I want to double back on. I think we talked about it earlier or whatever, when it was like people who bounce from job to job, and like those are the ones that will probably get a difficult time, showing their work history and everything. Like myself, for me, I'm a contractor. I work overseas. And I know that there's a lot of people out there just like me who work overseas or whatever, but they make good money in the process. But the way that the contracting biz works is a particular company can be there today, but the next week or month or whatever, another company comes in and outbids them, or the way that we understand it is they underbid or whatever. But whatever it is, a new company comes in to take the contract or whatever, shift people around and stuff like that. If you decide to stay on with the company, if they decide to keep you and stuff like that. So have you seen any cases where you've had contractors who work overseas, similar to myself, and but they make good money, you know what I mean, but their work history, or maybe their job title or whatever, changes with the new company that they go to, but there's a bit of consistency with the money that they're making because, again, they're still overseas?
Right. So I've done contract work before. I've processed a few loans for different government contractors, and it's understood that the job can change with any contract work that we do, whether you're a union worker or government employee or traveling nurse or teacher for that matter. All of those are pretty much contract jobs. So it's understood that the contract could change. It's understood that your employer could change. That is not viewed as unstable when it comes to lending guidelines. Have you consistently been earning money for the last 2 years? If your contract changed and you had a break for a month or two here or there, waiting to go on the next one, all of that stuff is understandable. It's all makes sense. It's all logical. What would be risky would be if you were doing your government contract for about 6 months, and then let's say when the company got bought out, you didn't want to go with the new company. So now you're going to go be a teacher for a year. And then after you get done with your teaching contract, or you stop that midway to go pick up, being a truck driver because you like to do those. That's random. That's sporadic. That's all over the place. We can't bank on your income. We can't bank on you to sit down long enough to stay and keep a job. So that's more of what's considered risky. You being in contract work, if you've done contract work for the last 10, 15 years, that's stable. That's amazing. There's way less risk with that, because most people don't just up and quit their job after 15 years, or they do, but it's going to a better opportunity. So let's say even if you have your contract jobs and then you decided, I want to go do something else, if you're increasing your earning potential and if it makes sense, like let's say you've been doing contract work and you've been I don't know, what do you like, weapons training, and then now you want to go be a master facilitator and train all, like it makes sense. So you can definitely progress and move on, and your job can shift. But at the bottom line is your income stable for at least 2 years? Is it going to be stable for the foreseeable future? Now, we have instances where with contract work and let's say military work as well, where you're buying a house and we're coming up to your contract's about to end and maybe you don't have another one in place yet. That could be a risk. And we might want to see that another contract has been lined up prior to finalizing your loan application. Or if your time has come up in the military and you're almost at your end of service date, if that's within, let's say you're buying a house now, but you're due to get out of the military within the next 3 months, we want to see, hey, what you doing when you get out? What, you got a job lined up? We need to see an offer letter, or because now that's foreseeable income in the future where your income is going to be changing. So yeah, you've been this great employee for the last 10, 15 years, but we also need to see that future income as well. And for granted, things happen. Nobody's perfect. Nobody intends to lose their job, but we can't have anything that blatantly says you're not going to have income within the next year or two. That can't happen.
So what if it's a career military person, like person who's done their 20 plus years and are eligible for retirement? Should they just wait until they're fully on retired and show that the retirement funds are coming in constantly, or?
No, you don't have to wait. You actually get, before you retire out of the military, they give you your projected retirement on what it's going to be. And we can take that as proof of your income. They document you out. They say you're eligible to retire. This is what the amount's going to be. And we can take that. Now, if you're getting out, let's say you did 6, 7 years and you're just about to get out. Yeah, you need to wait till you have another job. You need to wait till something else is lined up. Unless you have a confirmed offer letter, we can take those. So if you got out of the military in January and you don't really know what you're going to do, let's say you find a job February and it doesn't start until March, we can take that March contract saying that you're going to start work. They might ask for some reserve requirement because, again, you look risky because you don't have a job. So it's not a no, but okay, let me see how much money you have in the event that this job doesn't start. Are you going to be able to make this mortgage payment? So reserves pretty much makes a lot of situations better. If you don't have credit, they can use reserves as a compensating factor, and that's what they call it. So I'm not strong in this area, but I'm strong here. They'll look at that. So yeah, I'm about to get out of the military, but I've been stacking my money since I've been in there, and I got, $60,000, $70,000, $80,000. I'm okay. We would look at that and say, okay, this is not risk. If anything were to happen, he can go into savings and pay his bills, fine, and we're moving on. So any cash that you have can supplement, cash supplements negative income history. Cash can, or assets, I don't want to say cash because we're not using cash. Legitimate assets can supplement negative credit history, income. You can use it to pay down debt. So the more assets that you have involved in the transaction, that makes everything better. And we can look at that in lieu of if you have issues with, changing jobs or changing fields or anything surrounding your employment. If we can see that you have the money to cover your mortgage payment in lieu of whatever you have going on, that can be taken into consideration and, still proceed with the approval. And then if not, we'll tell you, okay, no, you need to be on your job 6 more months, or no, we need to see that you've started this job and you got your first paycheck. Like, we'll let you know. It's never a no. It could be a no now. It's never a firm no. I guess it could be a no now, but this is the plan that you need to make it work. There's always, always, always a plan to make it work. It's never a final no. I can never purchase a house. That is no situation ever in life. We can always put you on a plan to get you to where you're ready to buy a house.
Right. So, hope a lot of people out there take this information or whatever and kind of run with it. I know that COVID is like the big thing right now, so a lot of people aren't able to do what they had planned to do coming into 2020. Like 2020 has just been a really fucked up year for everybody pretty much, but this has been a really, really good interview, and I appreciate everything that you've done, all the questions that you answered and everything like that. But back to the top, I was telling my audience before we started that you were telling me that you had some information to provide them for people who were potentially looking for work themselves, who are out of work, and people who already have, employment, but looking for a career change.
Yep. So if you are interested in processing, and to really be interested in processing, the most background that they look for is if you have some type of customer service background. They say you could be a processor. And that's just because you're not rude to people on the phone. You can talk to multiple people. You can manage multiple conversations. Because there are a lot of moving parts when it comes to processing. You have to keep the one who's purchasing the home, you have to keep them up to date. You have appraisers that you talk to, you have closers, you have underwriters, you have the loan officer, there's realtors. So there's a lot of people that's involved to make sure that the home purchase goes as smoothly as possible. And it's the processor's job to keep all those people up to date and informed and get the loan moving to where everybody moves together and we close at one time, at one date. So if you're interested in processing, if you've processed before, and maybe you want to get back into it, or you've never processed at all and it just sounds like something that you would be interested in doing, my current employer, Caliber Home Loans, they're based out of Texas, and they have two separate programs. They have a senior processing program where if you already have experience, you can come right in and start processing. And then they also have a PACE program, PACE, where if you don't have any experience processing, let's say you worked at McDonald's before and now hey, I might want to get into processing. It sounds like something that's interesting to me. They have a PACE program where they will train you to process. So I'll provide the links. It's Caliber Home Loan Careers that you can go to, and you can search for PACE processing jobs or senior processing jobs if you've already had some experience and you're just looking for a change. I do work remote. So like I said, the company's based out of Texas. I live in Florida. I've never been to the company. I really don't have plans on going to the company. So that's how much remote I am. They ship you out all your equipment. So as long as you need to have a strong internet connection. But as far as phone and desktops and laptops, they send all of that stuff to you, and you can work from the comfort of your home. It's high volume right now, so there's definitely a lot of opportunities out there. There's a lot of loans out there to be processed. A lot of people are trying to get lower rates right now with the pandemic going on. So our volume is super, super high, and they definitely have opportunities available to you. And maybe not just even processing. If you want to get in the closing piece of it, or the underwriting piece of it, or loan officer, if you want to be upfront to take the application, or management position, or pricing with the locks. There's so many different avenues that you can take when it comes to a mortgage. So Caliber Home Loans is definitely they're where I'm at, and who I would plug right now in this moment. I will also provide links for if you want to, if you're looking to purchase a home and maybe you need some second chance lenders. Caliber's maybe, I wouldn't consider Caliber a second chance lender. They're more so if you do have a little bit more prestige credit and income and assets. They don't do if you've had extenuating circumstances, or if you've, maybe ran into some foreclosure and bankruptcy activity. They're not as lenient on those, but I have tons of lenders who are. So I'll put that information in there as well. If you're looking to buy a home, or you just want to know where do I start, or, this is my situation, what kind of path can I get on? I can put my information in there as well to help you through whatever you need. But I definitely want to be a resource to anyone who's interested in getting into processing, buying a home, refinancing a home. Home ownership is huge, especially in our community, because we don't have a lot of it. And you think about creating generational wealth, and where, this woke movement is going in 2020, and we definitely want to own homes. We want to pass homes on to our kids. We want it, you get a home, get a family home, get a second home, a lake home, a beach house, and make that your family vacation home, and pass that on to generation to generation to generation. And they can use that, and it can be an asset. Like we talked about, taking equity out of the home. So if something were to happen, like, you can use that asset and you can pass that on to your kids. So I'm very big and huge on buying a home and being in home ownership. And even if you pay cash for your home, I'm not even saying, getting in 30 years of debt is the greatest thing to do. So even if you want to put yourself in a position to where I want to do some investment properties, I want to be able to pay off these mortgages, I definitely support, in all avenues, home ownership and passing it on. So any information that I can provide, any questions that you have, I'll be more than willing to answer. If I don't know, I'll find out the answer. So yeah, I'm super excited to pass it on.
What's up? So yeah, all of that information will be provided in the links below the video on YouTube or whatever. So Again, some really good information there, some good opportunities for people out there who, again, unemployed right now, or are in a situation where you have a job or whatever, a career field that you're just not too fond of, but you have some sort of customer service background and you're looking to get out of whatever it is you're doing, want to be able to work from home. Like, this is the time for you, this is the opportunity for you, and everything like that. So again, thanks to Shanika or whatever, and we're going to make sure that we get her we'll get her info, all in the links and everything below and everything. And then again, we'll provide another link for her. So any questions that I didn't ask to her that you probably still have questions about, she'll be able to come behind in the links that are provided and answer your questions for you, just so that you'll get your answer and everything like that. Um, but yeah, this is it's a great first show for frequently asked questions, and it did exactly what I wanted to do, which was ask some questions or whatever to get some answers and to provide it to the people or whatever. Because I know that there are a lot of first-time home buyers out there who are looking to buy their home here soon. There are a lot of people out there who are looking to invest in things like that. Um, so like all of this information that you provided, I'm hoping that it goes a long way to the people out there or whatever, and continue to grow my audience and everything, and just provide more and more information. I got my buddies, the photographers, that'll be on my next episode and everything. So um yeah, I mean, just I'm excited about this. I'm excited about frequently asked questions. I'm glad that you guys all tuned in. And thank you, Shanika, for taking the time out to do this interview. And I can get you over to TD
Well,
Jakes.
thank you for having me. Yay. I think we should do a round of applause right here. Like, yay.
Okay, I guess I can do it.
Thank you for having me. Thank you. Shout out to you for your first episode. Shout out to your amazing first guest.
I drink to that.
You did a good job. This was great.
Yeah, I think so too. Thank you. I really appreciate it. Like I said, this is some really good information and everything like that. Probably a lot of information that a lot of people didn't know. When it comes to home buying and everything like that, even for people who already have their homes that are looking for a secondary home to rent out and stuff like that. So hopefully they stay tuned throughout the entire show and got all the information that they needed just to be able to take that to the next level of home buying down the line or whatever, or even people who are well off and want to give their young ones some money to invest in their own home and stuff like that. So this is some really good information. And then again, like I said, also for the people who, again, the information for everybody who's looking for a new career path, be down in the links below. Shanika, thank you. And this is the very first episode of Frequently Asked Questions. So thanks everybody for watching.